and it's time for another Macro Monday where I get you ready for the week ahead in 5 minutes or less. Just as a reminder, as always, this is just a small snippet of our full Macro Monday newsletter. So if you're looking for more in-depth coverage on the week ahead, I highly suggest you check out the link I'm going to put in the description of this video. That will bring you straight to our full version of this week's newsletter. If you enjoy these videos, I think you'll really enjoy our full newsletter. As always, we're going to start with our chart of the week, and first some background. So as expected last week, the Federal Reserve lowered interest rates by 25 basis points, with 2 more cuts anticipated by year end. The chairman's remarks largely met expectations, upside risks to inflation and downside risks to employment. When the Fed's dual mandate diverges, the task falls on its forecasting ability to judge which risk poses the greater threat and steer policy accordingly. Right now, the Fed views labor market weakness as the primary concern, which explains both last week's cut and the dovish guidance into the end of this year. Still, the chairman framed the move as a risk management cut. This suggests looser policy could cushion against a sharper downturn in employment and growth, while emphasizing that conditions do not yet warrant the aggressive easing path currently implied by financial markets. So this week, our attention turns to August and September PMI trends on Tuesday, with preliminary September S&P Global PMI data. August readings for both manufacturing and services sat in the mid-50s, despite bearish tariff-related commentary. Philly Fed data for the month, while choppy, surprised sharply to the upside, underscoring that uncertainty and labor supply remain the primary constraints on capacity utilization. Also on Tuesday, the Richmond Fed data will be released, where results have lagged other regionals and the ISM and PMI benchmarks. These leading business cycle indicators continue to climb in step with the interest rate path of the last 18 months. Remember, we have previously gotten 100 basis points of cuts about a year ago. And we expect that momentum in PMIs, as the chart here shows, specifically the clip on the right, to persist through year end. And that brings us to our calendar. So we covered the several PMIs being released, but that's not all we have this week. The rest sort of revolves around housing. So on Wednesday and Thursday, our focus shifts to housing with building permits and existing and new home sales. A key leading gauge, the NAHB index, remains depressed as affordability right now is the main drag. Home prices are a part of the story, but mortgage rates carry more weight. Mortgage rates have fallen roughly 100 basis points since January. They now sit around 6.2%. Which is their lowest since 2022 and down from an 8% peak in late 2023. While the 200 basis points retreat may support some activity, many homeowners still remain locked into 3% or 4% mortgages, which has to date limited turnover. Survey data suggests a move to 4 to 5% mortgage rates would be needed before a meaningful housing recovery takes place. So all the housing data that comes out right now, we will be following closely, along with the many PMI data that we get. So again, Tuesday, S&P Manufacturing, S&P Services, the Richmond Fed, and then we have the Kansas City Manufacturing Index on Thursday. So that combined with housing, pretty busy week following the Fed's first of potentially a couple rate cuts for the rest of 2025. And that's what I'm going to leave you here today. Thank you guys for watching. I hope you have a great week, and don't forget to subscribe. I will see you right back here next week for another Macro Monday. Bye, everyone.